Welcome to our Deloitte webcast, Perspectives on Financial Accounting and Reporting. I'm John Kligman. I'm a partner in our national office, and I'll be your host for this webcast. Just a couple of housekeeping items before I introduce our speakers and agenda. If you'd like a copy of the slides for your reference, they're available for download on the same web page that you access this update. You can direct colleagues to the webcast by referring them to deloitte.ca/update. I'd like to remind viewers that our comments on this webcast represent our own personal views and don't constitute official interpretive accounting guidance from Deloitte. Before taking any action on any of these issues, it's always a good idea to check with a qualified advisor. Please know that Deloitte won't be issuing professional development certificates for attending this webcast. We encourage you to check with your provincial institute or order regarding potential continuing professional development credits. We're joined by four speakers who will be facilitating today's three-part webcast. Kerry Daniluk joined Deloitte as a partner in 2006 with over 20 years' experience in public practice, standard setting, and industry. Kerry is currently a partner in Deloitte's National Audit and Assurance Services Group and specializes in a variety of areas of IFRS, ASPE, and not-for-profit accounting. Alexia Donahue is a senior manager within Deloitte's National Audit and Assurance Services Group. Alexia shares her time between accounting consultations and monitoring quality standards for Deloitte's public company client filings and financial reporting matters. Matt Walczynski is an audit partner and member of Deloitte's Accounting and Transaction Advisory Team, where he specializes in the application of complex, new, and emerging accounting standards and securities offerings. Matt focuses a significant amount of his time leading audits of public companies in a variety of industries. Jen Boldy is a senior manager within Deloitte's National Assurance Services Group. Jen spends the majority of her time leading implementation efforts for the new auditor reporting standards and developing related guidance. Jen also assists our public company audit teams with their audit committee communications. For your viewing convenience, this webcast is organized into three separate videos. Please refer back to the main page to view the remaining videos in this series. We'll begin with part one of our webcast, providing you with a number of year-end reminders, addressing standards effective on or after January 1st, 2017, recent International Financial Reporting Interpretations Committee agenda decisions, accounting considerations for current events, and disclosures on standards issued but not yet effective. Please note that throughout this presentation we'll refer to the International Financial Reporting Interpretations Committee as the IFRIC. And with that, I'd like to pass it over to our first speaker, Kerry Daniluk, who started us off with our year-end reminders. Over to you, Kerry.
Thanks, John. Okay, so the first slide is just showing, I guess happily for this year end, we don't have too many financial statement standards that need to be applied in the year end financial statements, I guess giving us a little bit of a rest as we lead up into the big year coming with the big new standards being revenue and financial instruments that have to be adopted in 2018. So first of all, the next slide just goes into a little bit more detail about the new disclosure requirements related to IAS 7, which is the cash flow standard in IFRS. And so you can see the top part of the slide just shows an excerpt from the company's cash flow statement, and it shows the cash flows related to financing activities and in particular the debt instruments that this company has. And then what the bottom part of the slide is showing is one way that you could use to meet the new disclosure requirements of IAS 7, which is basically to show the movements in these financial liabilities as by way of note disclosure. So some companies may have been providing this through the quarters of 2017, but if you haven't done so in the quarters, then you certainly need to do so for year end. And I guess just one thing that I want to keep in mind is this is just kind of one way to do it. It's the example from the standard itself. And I guess the other thing to think about is just don't confine your thinking to just the traditional debt instruments. I think that this disclosure would also capture anything like if you had issued preferred shares, for example, that were presented as liabilities. They would be, because they're in substance treated as debt instruments for accounting purposes, I think that they would be also subject to being included in this disclosure now required under IAS 7. So the next thing I want to talk about, and it's sort of, I'm talking about it kind of in advance of some discussions around some IFRIC agenda decisions that I'm going to go into shortly. But I think one of the things people might be aware of if you follow the agenda decisions at all, that sometimes when the IFRIC considers an issue, even when they don't take it on and decide to do a new IFRIC standard, they issue a report, and oftentimes in those reports they come out with views that may be seen to limit practice. So they might say, well, we observe that the standard is clear, and they talk about, what they think, sort of in a sense, what they think the standard actually says, actually without coming out with a traditional standard per se. And so when this happens, we always are sort of faced with the question of, well, when do we have to adopt them? Is it retrospective? What's the nature of that change? And I think typically companies have tended to think about it as almost akin to an accounting policy change, because often the IFRIC observes, practice has been this or that, and we think that maybe that we would observe that maybe just the one method is the preferred or perhaps only method that should be followed. And so when this happens, when they come out, they don't, unlike when a standard comes out, it tends to have a bit of a delayed implementation date, whereas the IFRICs come out with sort of no transitional provisions in these agenda decisions. So recognizing this problem, the IFRIC has and the accounting and the International Accounting Standards Board have thought about what should be, what are some transitional, what are the transitional considerations for adopting, let's say, an agenda decision. And so they're working on some amendments to IAS 8, and they're outlined on the screen here. And basically what one of the proposals that they're looking at is to talk about how such a change, if a change needs to be applied as a result of one of these agenda decisions, and answering the question about whether it needs to be done retrospectively with restatement. And so they've kind of come up with this idea that it should be retrospective unless it's impracticable to determine the impact or the cost would outweigh the benefits. So this is kind of their current proposal that they're working on. We expect to see this come out shortly. An exposure draft, it's noted, is expected in Q1. So I just thought that would be interesting to note as we look at some of the agenda decisions that the IFRIC has worked on this year. And people may want to watch for that exposure draft to come out and provide comments if they feel so inclined. So the first one I was going to talk about was the okay, so this slide has the list of all of the agenda decisions, or the major ones that they've come out with this year. So the top part are the final ones. So these are the ones that I was just talking about that can sometimes have the effect of changing practice. These can all be found if you're interested to find them, on ifrs.org, and they always come out in the IFRIC meeting summary. So if you're looking for one that came out after the March meeting, let's say, then you would go to the March meeting report, and it would have the wording of that agenda decision summary. The middle ones listed there are tentative, so that means that often their process, or what they always do really, is they come out with what they think the agenda decision is going to say, and then I'm not sure that a lot of people actually know this, but there is the opportunity to comment on those, and so you can, I think it's about a 60-day period that you can comment on those open tentative agenda decisions, so that people can kind of make their views known about the wording that the IFRIC expects to come out with, and then after they consider those comments, they finalize them. And then the bottom part of the slide just is providing, for completeness, kind of a list of all the things that they talked about in the recent November meeting. So the first IFRIC We've selected a few to talk about in this webcast. And so the first of those that I was going to talk about relates to IAS 12 income taxes. And this is recognition of deferred tax assets when acquiring when acquiring a single asset entity that's not a business. So in this fact pattern, the question was posed about what happens when an entity acquires something that's not a business. So in this case, it was investment property. Fair value of the investment property was 100, and the buyer paid 90 for the property, and that included some tax attributes, and we would have had a deferred tax liability of 10. So the question was, as people who are familiar with IAS 12 might remember, is that on initial recognition of certain assets, or I guess assets or liabilities, but in this case it's an asset, there is the initial recognition exemption, which basically says that you do not record any deferred taxes in certain cases. And so the question was asked, how would that apply in this situation? And so the IFRIC agenda decision does say that the initial recognition exemption does apply, such that the entity would not record a deferred tax liability in this case. So they would allocate the entire purchase price of 90 just to the investment property, not record a deferred tax liability. And then it recognizes further, the agenda decision that is, that a day two gain might result at the next point when that investment property is fair valued. So that is kind of an expression of the IFRIC's views on that question. They decided not to come out with a formal IFRIC on that, and they just have released their comments by way of an agenda decision. The next one on our list to talk about is investments in associates and joint ventures. And this is the fund manager's assessment of significant influence. So in this issue, and it may seem like a fairly narrow issue, but I think it potentially has some broader application. So under IFRS 10, which is the control and consolidation standard, there is some notion of a fund manager or a manager possibly having control and having to consolidate the entity that it's managing. So this could arise where the decisions that the fund manager makes are so broad that they have power, and as well, if they have a significant enough investment, they could end up having to consolidate. And this comes up in the mutual fund industry and could also come up elsewhere. So the question was raised, what about significant influence? So under IAS 28, should we be looking to the same notion? Could a fund manager, instead of concluding that they have control, should they be looking to whether they have significant influence, and should be equity accounting in that case? And so, for example, equity accounting, maybe when they have less than sort of a 20% investment, let's say, but they have their power or ability to influence through, let's say, their fund management contract. So what the IFRIC kind of observed on this in response to this question was that the definition of significant influence was not changed when IFRS 10 was released, and therefore significant influence is really just assessed in the context of applying IAS 28, and there seems to be no need to look to notions similar to what we would see in IFRS 10 about having to look at the contract and whether you have sort of a significant influence by virtue of your ability to make fund management or other kinds of decisions. So I think this one's interesting because it in a sense clarifies that there's not the expectation that we sort of start, so that managers, property managers, project managers would not seem to have to look. They need to think about whether they have control, but once they get past that, then they're more, they're not having to kind of look at the nature of their influence based on that contract and coming up necessarily with a equity accounting conclusion that that they have significant influence. Of course, such a contract would be factored into the more holistic analysis that an investor needs to make in around its investee and whether it has significant influence over an investee. But it would just be one factor. We're not looking for a similar analysis that would be required under IFRS 10 for, say, fund managers. The next one that I'm going to talk about relates to interest and penalties. And the question really is related to income taxes. So, for example, interest arises from late payment. It could arise from disagreements with tax positions, and so the company files and pays their taxes on a certain basis, and using a certain tax position, they get assessed later. The tax authorities decide that more is owed, interest is charged, sometimes penalties as well. And so the ongoing question has been whether those interest and penalties should form part of the tax provision or whether they should be recorded elsewhere in the income statement as, I guess, more akin to where you would put interest and other expenses. So the decision, the agenda decision, unfortunately, I guess the one thing it says that's clear is that it's not an accounting policy choice. And I think many might have viewed this as an accounting policy choice in the past. And so what they've said is that it's not a pure accounting policy choice. So at this point, it seems that companies should be looking at their situation and deciding, whether they think that their interest and penalties is really something that should be included in the tax provision or whether it belongs outside the tax provision. But not a lot of guidance has been given as to how to make that judgment. So I think it, in a sense, remains to be seen a bit how this will be applied in practice. I think one other thing worthy of mention is that it often may be that these items are not very material in the context of the financial statements taken as a whole. But I think it's one to watch out for. It could potentially limit practice and make some differences to, depending on this on a company's situation and how significant these things are. The next issue is a fairly narrow issue. Just mention it because it's maybe interesting if you have this sort of situation. So the situation is a pharmaceutical entity acquires goods such as refrigerators and watches or really anything to distribute to doctors in this particular fact pattern as part of promotional activities. So there's no obligation to provide, but I guess they might be providing these as special gifts. And it wouldn't have to necessarily be pharmaceutical entities to doctors. It could arise in other contexts. And so the question here is, really the company has acquired something that potentially has some value, but they're going to be just simply distributed by way of gift. So the question is, how should these be accounted for at the reporting date if, let's say, you have some of these remaining on hand? Is it inventory or, exactly what is it? So the IFRIC observed that goods like this that are acquired solely to be used for these kinds of promotional activities should be expensed, and so it would not be expected to see, you wouldn't be expected to have inventory at the period end if you had these things on hand. They should have been expensed in the period, regardless of whether they've been distributed. The next one, this one's a little bit more involved than the other ones I've mentioned. We have an example coming up on the next slide, but what I will talk about just in general terms, what this decision addresses. And this question actually does come up with some frequency in practice. So the question is here, you're acquiring a group of assets that do not constitute a business. And so right there, we know that it's not covered necessarily by IFRS 3. Which is the business combination standard, although IFRS 3 does make some comments about how you would allocate your purchase price to a basket of goods like this, and it talks about doing so on a kind of a relative fair value basis, so take the cost and allocate it on a relative basis. So where this starts to pose a little bit of an issue is where some of the assets that are acquired are things that are recorded naturally at other than historical cost. So a very common example is certain financial instruments that need to be recorded at fair value on an ongoing basis. So the question is really what do we do? We allocate based on cost at the first instance, and then what accounting kicks in for those items that are supposed to be at fair value. So the IFRIC identified two broad approaches, and the first one is to basically allocate the cost to the group of assets, basically the way IFRS 3 tells you to, and then look at everything and take those things that are supposed to be recorded at fair value, let's say, and do that, and then that could give rise to day one gains or losses for those instruments, and IAS 39, IFRS 9 would tell us how to deal with those. The other approach is to sort of take everything that should be measured at fair value and measure it at fair value, and then kind of allocate the rest of the cost to like the remaining cost to those items. So let's look at an example that'll probably make it a bit more clear. So on the next slide, we have this, we've acquired this basket of assets. There's PP&E, there's a biological asset, which of course would also be recorded at fair value, and then we've got financial instruments that would be recorded at fair value. And so under approach 1, basically they've taken the transaction price and allocated it, and then they've recorded the instruments that need to be at fair value, and so you can see we've got the day one gain or loss. Now, not to say we said immediate gain or loss, you wouldn't always necessarily record that immediately in P&L. You'd have to look to the standards, and so for example, for the financial asset, it would be IAS 39 right now, and soon IFRS 9, and there might be situations under which you would defer that day one gain or loss. And then the second approach is basically to put everything at fair value, or the things that need to be at fair value on an ongoing basis. So the biological asset at 200 and the financial asset at 50, and then that just sort of leaves the remainder to go to the PP&E, which is the historical cost asset. So it's an interesting, somewhat helpful agenda decision that I think people could use if they're facing such acquisitions, and it does, as noted, acknowledge that there might be two approaches to follow here. And I think with that, John, that's the those are the IFRICs that we wanted to highlight this session, and I'll turn it back to you.
Thanks very much, Carrie. IFRICs certainly covered a lot of ground this year. That slide you had showing the list of their projects was quite daunting. Well, now we'll turn it over to Alexia Donahue, who will be taking us through some financial reporting implications of various current events. Over to you, Alexia.
Thank you, John. So I guess one of the sort of reminders we wanted to provide as we move into the year-end, or we'll say the December year-end reporting period, is just with regards to the changes to the Bank of Canada published exchange rates. So we, I guess, originally discussed this in last year's webcast, but sort of as the change has gone live, which was done on May 1st of this year, 2017, to the extent that people haven't sort of had to face or haven't revisited the impact of these changes, just a reminder now that, you know, trying to assess what impacts it may have on your financial statements and your account or your accounting records and business processes, and then just reiterating the fact that in terms of the guidance of what should be used under IFRS and where we're translating different balances, it's the concept of both the closing and the spot exchange rates. So the closing rate is defined as a spot exchange rate that is at the end of the reporting period, and the spot exchange rate is the exchange rate for immediate delivery. And just in the concept of the guidance and a reminder that what is now being published on the Bank of Canada website is a daily average, which basically is reflective of all of the different foreign exchange sort of transactions that would have occurred during the Canadian working day. So just something to think about in terms of, you know, potential IT impacts, internal controls, measurement from a financial statement concept. And the next thing we sort of wanted to discuss, or that we're going to discuss, is the Ontario Cap and Trade program came into effect on January 1st of this year. There's been a number of auctions, so, you know, ability for participants, whether they are mandatory, voluntary, or market participants, to you know, buy and sell different credits. And at a very high level, basically the province of Ontario, based on historical emissions records, granted the mandatory and, to the extent applicable, the voluntary participants some credits. And basically these allowances need to be monitored, and to the extent that you've exceeded the emissions allowances, then you need, which is your sort of cap, so the amount of greenhouse gases that you are permitted to emit, to the extent that that allowance or that cap is exceeded, then companies have the ability to go out and trade, so buy, sell, and then there's also secondary market purchases where they'll be putting credits back into the market, or reissuing additional credits in order to ensure that they have not exceeded that cap. So really, I guess the takeaway here is I think we had expected to hear a lot more buzz around the adoption of this program. So just really understanding whether or not your organization is a participant. Our understanding is that it also captures, companies that are not necessarily located in Ontario but may have clients in Ontario or operations in Ontario. So just ensuring that you're aware of your requirements, and that I guess the next thing is you know how to best account for it. So as you can see from this slide, and I won't go through all of the pieces, there isn't any specific accounting as to how these programs, and inclusive of the Ontario Cap and Trade program, how they should be accounted for. There are, however, sort of three broad approaches, and so in no particular order, and the one that we've called Approach 1. Essentially what it is, it follows a methodology of IFRIC 3 emissions rights, which was an IFRIC interpretation that has subsequently been withdrawn. And then there's sort of two other approaches which are variations that may also be acceptable, just given the fact that there isn't any accounting rules to the contrary. So the sort of takeaway here is, one, just a reminder that the Ontario Cap and Trade program did come into effect this year, and then two, as we're moving into year end, just making sure that, one, you're aware whether or not you're caught by the program, and then two, sort of thinking through, to the extent you are caught by the program, how to or what your accounting policy would be in terms of accounting for that program. And then finally, unfortunately, 2017, we've seen a number of natural disasters ranging from, wild forests to floods and hurricanes. And we just sort of wanted to take a moment to remind people that these natural disasters can also have financial reporting implications. So the most obvious of which is probably impairment considerations. So to the extent that you need to record impairments with regards to your non-financial assets, so PP&E or intangibles, there may also be some potential impairments related to your financial instruments or financial assets. So it could be, unfortunately, as a result, you won't be able to recover some accounts receivable or loans that were outstanding. Another sort of item we wanted to point out when we're thinking about accounting for natural disasters is with regards to insurance recoveries. So there's specific guidance in IS 37 that talks about when to record contingent assets. So really the takeaway there is disclosure is required until disclosure is required when the economic inflow is probable, and you would actually only be recovering your recoveries once they've actually been received. The other sort of item to sort of think about is the presentation of losses. I think although they may be extraordinary in terms of the impact to your business or operations, there's no concept of extraordinary items within a set of financial statements. So just a reminder that, although these costs hopefully are not reoccurring in nature, that the IS1 specifically prohibits the presentation of items as extraordinary items. And then I guess the sort of last takeaway maybe is the extent you've been impacted is just with regards to provisions for remediation and cleanup costs that may have or will be incurred as a result of a natural disaster that may have impacted your operations. And that's it in terms of current events. So the last thing we sort of want to talk about in the context of our accounting considerations for year end is with regards to disclosures on standards issued but not yet effective. So I believe this is a message that you've probably heard many times and will continue to hear as we count down to January 1st, 2018. And it's just reiterated that there continues to be increased focus by the regulators, both here in Canada and the US, with regards to these disclosures, specifically in the context of IFRS 9 and IFRS 15, and to be honest, increasingly in the context of IFRS 16, which is the leasing standard. With regards to, the technical requirements and a set of IFRS financial statements, IS 830 does require disclosure of known or reasonable estimatable information relevant to assessing the possible impact that any application of new IFRSs may have on financial statements. And basically what it is it's trying, or I guess ideally what the disclosure should be is relevant and not necessarily reliable, but relevant and useful for users to understand what will happen post-adoption. So, ensuring that you've disclosed your transition method or anticipated impacts on major line items. And again, just trying to reiterate the fact that it should be I'll call it a group effort. So regulators are encouraging, management to not sort of take this on by themselves, ensuring that they're having communications with their audit committees and their auditors, just to reinforce that, it needs to be an iterative process with all of the key stakeholders involved. And then in terms of what should I be disclosing for these new standards that are issued but not yet effective, as I previously mentioned, the transition method. So are we going modified or full retrospective application for IFRS 15? To the extent you're not done, which you should be by the time your year-end financial statements are filed, sort of the status of your transition and any significant milestones that still need to be reached. And then also thinking about whether or not there are implications on your ICFR or on your IT systems that should be communicated to financial statement users, or maybe that's something that you want to communicate to your stakeholders and it can be included in your MD&A. So really there's a number of different considerations. If you look at National Instrument 51-102, it talks about, in the context of your MD&A, discussing where there would be accounting alternatives and then the alternative that was chosen and why it was chosen. So again, thinking about sort of as you're making significant judgments and estimates and working through the new standards, if it's material to your operations, ensuring that that's appropriately communicated through your continuous disclosure documents. And I guess with that, John, I'll turn it back to you.
Okay, thank you very much, Alexia. Accounting has to keep up with worldly events. We invite you to join us in our next video where Alexia will take us through some securities reminders that will assist you as you begin to prepare your annual financial statements and continuous disclosure reports. Jen Boldy will then follow up with some insights into the effective dates and key changes to the auditor's report.